So guys, did you know that synthetic indices like volatility indices, boom and crash, and all other synthetic indices instruments can be traded with technical analysis and price action? Yay, this is Courage, and in this video I'm gonna walk you through a technical analysis crash course, which means in this video you are going to master technical analysis in less than 1 hour. So here's what you are going to learn. Number one, we are going to learn the top 3 mistakes that technical traders make, and that the mistakes makes them lose money. And I'm gonna also show you how to avoid those mistakes. I'm gonna show you how to know when to buy, sell, or stay away from the market. Also, I'm gonna show you how to know the best zones in the market to trade, right? You want to know which zones in the market should I be looking to place my trades. And also I'm gonna show you how to avoid getting into the market too soon and too late. I also show you where to place your stop loss and take profits. In this process we are going to see a lot more examples. So let's start off with the top 3 mistakes that traders make in technical analysis. The first mistake is trying to learn everything in technical analysis. You see, when I started learning about technical analysis, I went through a long journey of learning everything that I could. I learned about Fibonacci tools, I learned about support and resistance, I learned about all the indicators. I tried to learn about trend lines, all the things that is there in forex trading, right? I learned almost everything. I don't know how many books I have read about trading, right? And that is not I would say it's okay to learn more things, but it's not good for your trading, and I'm gonna show you why, right? The next thing is too many indicators. Using too many indicators on your charts. You see, most people, when they get into the chart, what they start looking for is placing too many indicators: the RSI, the moving average, the average true range, the MACD, the Bollinger Bands, the stochastic indicators, right? Like everything on the chart, and they will end up with a chart which is too messed up, right? And this can be related to trying to learn everything, because if you do these things, what happens is you are going to end up with what is called analysis paralysis, right? You have too many things to know and you don't know what to do next. You don't have now the confluence that you need to place the trade, right? Because the MACD and the moving average is aligning, but now you see that the Bollinger Bands is below what you want it to be. Now you end up placing no trades at all, right? The number 3 thing, which is the core concept of this video, is working with no framework or plan, right? You see, most traders, what they do is they just go into the market, they try buying, and then they lose. They say, okay, I lost in buying, let me try to sell. And now they sell, they lose again, they try buying. Now you end up gambling, not trading, right? Because there should be a difference with sports betting, gambling, and trading, right? So if you see yourself trading without no plan, you are simply gambling. And now let me show you the simple framework, the only 4 things that you need to focus on in technical analysis for you to start making money and master technical analysis. You don't need many things, you only need these 4 things. And let's start off with the framework. So this is the framework. This is the only thing that matter in your trading, right? Number 1 is market structure. Market structure is simply market direction. Simply knowing what is the market doing at this time. Is the market in an uptrend? Is the market in a downtrend? Is the market in a sideways trend, right? Because if the market is in an uptrend going up, you want to be buying, and if the market is going down in a downtrend, you look to be selling. And if the market in a sideways, you are looking for major support of levels of support and resistance, right? So you want to know where is my market before you enter even the trade, right? What a good trader does, if he enter into the market and see that the market is in an uptrend, he knows that in this current pair, I'm only looking for buy opportunities. If I open boom and crash and I see that the market is going in a downtrend, I will always place a trade if I see an opportunity to sell, right? I will never buy in a downtrend and I will never sell in an uptrend. So that's what you want to do, and that is why you need market structure. Number 2 is area of value. So area of value is what tells you where to buy, where exactly should you place the trade, right? Number 3 is entry trigger. You need to know exactly what is it that makes you enter the trade. You need to know exactly what triggers you to click that buy button or that sell button. Then number 4, you need to master the exit, right? The exit is before you even place your trade, you need to know, if I enter this trade, how am I going to exit? Because entering the trade without knowing the levels where you're going to exit is one thing that makes people blow their account, because they will end up keep hoping that the market is going to reverse, the market is going to reverse. But if you consider that if the market touches this level, I'm going to go out of the market. I don't care if it rises again. Now let's dive deep into all these things and start off with the market structure. Let me tell you what to do and how to identify the direction of the market, which is market structure. This is the first thing that you need. So the market structure is what tells you what to do in the market, and also it helps you decide, should you buy, should you sell, or should you stay away from the market. And the market structure consists of 3 things: an uptrend, a downtrend, and sideways trends, right? Let me show you how to identify these directions. That how do you know if the market is in an uptrend, if the market is in a downtrend, or if the market is just in a sideways trend? So let's move on to how to identify market structure. So market structure, there are 2 ways of identifying. Number 1 is price action, right? Price action is simply spotting levels of higher highs and higher lows, or lower lows or lower highs, or simply identify support and resistance. I'm going to show you how this works. Number 2 is using indicators. You can use indicators like the MACD, the moving average, the Bollinger Bands, to see if the market is in an uptrend, the downtrend, or sideways trends. I'm going to show you an example of how you use the moving average, for example, to identify the market direction, which is market structure. This is the first thing that you need to know. If you know, if my market is in an uptrend, I'm only going to be looking for buying opportunity. So now I want you to understand how to see the direction of the market, right? Now the first way that you can do is using what is called price action. So what price action simply means is, if the market was here and it makes in a move up, right? So let me do this. So let's say if the market was in an uptrend, right? So it makes a move like this. It makes a move like this, right? This is called an impulsive move, right? So after the impulsive move, what happens next is you are going to see a pullback, right? So this is called a pullback, right? And then next you see another impulsive moves, right? Another impulsive move, and after that impulsive move, you are going to see another pullback, and after that pullback, you are going to see an impulsive move again. So what do we call this? We call this an uptrend. And why do we call it an uptrend? Because you can see that each and every impulsive move, 1, 2, 3 impulsive moves, it is breaking above a recent higher high. So we call this a higher high. So each and every impulsive move, right? If you see a market moving up, making a pullback, and then moving up, if the next pullback break past this first higher high, then now it creates a new higher high. And that shows that the market is in an uptrend. So we at the end, we are going to have a series of higher highs and higher lows. So we say the market is like this. We have a series of higher highs and higher lows, right? Now let me show you a perfect example in the market how this works. So this is where you can identify the market with price action. So for example, if you look at this market right now, you can see that we are making a series of higher highs and higher lows, higher highs, higher lows, higher highs, higher lows, right? Now you can see that this is higher high, this is higher low, higher high, higher low, higher high, higher low. And now if the market continues from now, it's possible that the market is going to move going up. So in this type of the market, you are always looking to buy because you make profits going up in an uptrend. Because if you sell in this market, for example, imagine if you sell right here. Imagine if you sell right here after seeing this small pullback here, you sell right here, you sell, and you don't place a stop loss, and you go somewhere, right? Or the network, the network does what it does to most traders, right? And then you don't have a stop loss here, and after like 5 minutes, right, you see how, you know how volatility moves, how volatility 75 moves, right? If after 5 minutes you come back, you see that the market is now at this level here. How much money do you think you should have lost in this type of trade? I bet you for most people in this channel who are trading small accounts like $50, $100, $20, you come up to the market and see that your account is red and out, right? So you always want to follow the market structure. Understand this. Number two, the next way that you can see the market structure is using levels of support and resistance, right? So if you look at this market here, you can see that I have this level here. So let me do this. I have this level here and this level here. So these two levels here are the levels of support and resistance, right? Because if you look here, you can see that the market was moving from this point here to this point here, from this point here to this point here, from this point here to this point here, right? As you can see, the market is moving below a level, right? So it's going up, down, up, down, up, down, right? So with this type of market, you want to be buying low and selling high. So for example, you want to be buying at this level here, you want to be buying here, you want to be buying here, you want to be buying here, and selling at the top here. So how do you trade in this type of trades? It is the next thing that we are going to look at before I tell you that these are the areas of value, right? But before we move on to the area of value, let me show you one more example of how do you use price action to determine the trend. So here's another example. As you can see, we have the market making a series of lower highs, lower lows, and higher lows, right? So as you can see, we can call this a lower low, we can call this a lower high, we can call this a lower low, a lower high, lower low, lower high, lower low, and lower high, right? And then if you see this kind of thing, right, if you master, right, so let's say you focus on mastering market structure first before moving to all these things, right? If you can go to the charts right now and on the first glance of the look, you can say, okay, this is a downtrend. Then you are now likely to be making money in the forex market. So let me give you one tip that you needed. If you can't really tell if the market is in an uptrend, downtrend, just take some few steps away from the computer, right? Because if you are really close to the computer, you might say, okay, I don't see really what is happening here. You can just move away from the computer a little bit and see from somewhere. Or you can resize here. You can zoom this thing here. You can zoom these candles and make them small. As you can see in my examples, I use smaller candles, right? So I zoom my market, I zoom my charts so that I can simply you can simply understand what I'm talking about. So it's much easier to look at the charts when the size of the charts is really small like this. Now, let me show you how to use indicators to identify market structure before we move on to the area of value. So if you can see, if you can look at this, you can see that the green line that I have here is the moving average. So this green line is the moving average. So what this green line does is, the moving average is simply the calculation of the average of the closing prices of each and every candle here. So it calculates automatically. You don't have to calculate it. It calculates automatically. Just insert indicators and you select the moving average and it's gonna come out like this, right? So what this does is it's an average. So as you always know, the average follows where the direction is going. So average, the moving average simply calculates the closing prices of candles, right? Now, simply know that if the market is above any moving average that you put, right, and the longer the moving average, for example, the line here is a 50 period moving average. If I put a 21 period moving average, you can see that the moving average will likely follow near the candles. If I put the 200, you can see that the 200 might move maybe like this, right? So the more the range, the smaller, the closer the average, the moving average to the candles. And for me, I can advise you that use either 50, because you want to use a moving average which is a little bit far from the candles, right? So that you don't have to be placing a lot of trades. You want to be trading responsibly, right? Now let's move on to the area of value. Now you know that how to identify what is the direction of the market. Now let's talk about how do you know the places where to buy, right? Because you don't just buy because you're in an uptrend, but you want to know where is the zone where I should be looking to buy. So the area of value tells you the area where buyers and sellers could step in to reverse the market, because you don't want to be entering the trade based on your own your own time. You just guess, right? But you want to be identify levels where other traders might be looking also to trade. Also, obviously you don't know where exactly am I gonna place the trade, but there are zones in the market where most people are likely to be placing trades. And how do I know this? Because if I trade using support and resistance, if I see a price on a support level, I'm looking to buy. And if you do the same thing, and I know that most people, they use these strategies, right? These are like self-fulfilling prophets, right? Like you say, okay, I'm gonna trust this, and someone trusts it. Just the same thing that happened with Bitcoin, right? When people started investing in Bitcoin, they just started to trust Bitcoin and just invest, and boom, Bitcoin exploded, and many people became millionaires before they even knew, right? So how do you identify area of value? So the first, one of the best way to identify area of value is support and resistance. And why do I say this is the best? As I said, most people, they know about support and resistance. Most people, they trade using support and resistance, right? So what is support and resistance? Support and resistance are areas in the market where prices are likely to reverse on. So for example, we have our market which looks like something like this, right? Moving up, down, up, down, up, down, up, down, up, down, right? And then we end up having a level like this. We can say that this is a support and resistance level. Why do you say that? Because we are seeing that at this area, the market has been respecting this area, respecting. And now, if the market comes down to this level again, what do you think? I'm going to assume, okay, if the market was bouncing from these levels, the market is also going to bounce from this level, right? Because I'm thinking that, and you are thinking the same, because you trade using support and resistance. You say, okay, this is the level of support. The prices are likely to bounce because it has been bouncing from this level. Let me buy. And you buy, I buy. Many people buy, and the buyers come and take the positions. Buyers take control, and now obviously the market is going to go up. Buyers make profits, right? So support and resistance is one of the best ways to identify area of value. Now, let me show you real examples of how support and resistance come into play, right? So this is a chart with a good support and resistance level example, right? So as you can see, the price has been moving from this point here, moving from this point here to this point here, moving from this point, right? As you can see, each and every move of the market was coming back down to this blue line here. So the market moved up, back to the blue line, up, back to the blue line, up, back to the blue line. So the blue line here is our support level. So we call this a trend line. So if you open MetaTrader, you're going to see the trend lines. Maybe you have been seeing trend lines, and trend lines can be used as support and resistance, right? And you can also have support and resistance when the market is just moving in the sideways, right? This is the most time you are going to see the market moving in a sideway, and you have support and resistance. So support and resistance is the area of value, and it tells you where to buy, right? Think about this. Now you know that market structure tells you the direction. You know that now you enter into the market, you see that this is an uptrend, and you say, okay, I this is an uptrend, so I'm looking to buy. Each and every trade that I'm gonna place in this market is a buy trade, right? And now you see, okay, now you know that you are going to buy. You have increased your chances of winning because you want to buy in an uptrend, which is a good thing. Number two is you're now looking for area of value. Now you are not just buying for the sake of buying. Now you are saying, okay, I'm looking to buy at an area of value, at a support level. So I'm looking at an area to buy in an uptrend, right? Now you have increased your chances of winning. Now there are two things that you are left with. You only need now to know where exactly should I buy and where exactly should I take my profits and exit, right? So this is what we are going to do next. But before we do that, if you are enjoying this course, make sure you smash that like button. If you are new to this channel, click that subscribe button, and let's move on. So before we go to the end trigger, I just want to tell you about something. I just want to tell you about something about the support and resistance, right? One thing you need to know is support and resistance act like this. When the market moves to the upside, right, and move back down, this point here is points where buyers think that, okay, this is an area of value, let me buy. And if there is more buyers in the market is going to go up, right? What you need to understand is what moves the market is the amount of buyers versus the amount of sellers. So if there are more buyers in the market than sellers, then the market is going to go up because buyers have got power. So you know that even in shops, if you go to the shop, in any business, if the supply is more than the demand, the prices are going to fall. And the supply is the sellers, right? Because they are the one that is selling to people. And the buyers are the demand, the demand, right? The buyers are the people who give money to the sellers, right? So if there is more buyers than sellers, if you go to the market right now and you see that there's 20 people who want to buy 15 things, the seller is going to say, okay, I'm increasing the price so that whoever can buy will afford it, right? This has been happening a lot. Let me give you another example, right? Let's say you go to the rank to take a taxi home, right? And it's like 9 p.m. in the evening, right? What happens there is those people who work there will say, okay, if you were paying $1 for this trip, now we are charging $2. Why do they do that? They know that now you have no choice because there is more demand than the supply. It's only the supply, and there's 30 people, and his car can only take 20 people. So he knows that if he raises the price, you're going to buy because he knows that you don't have any other options. So this is what exactly happens in the market. If there is more sellers, the price is going to fall. If there's more buyers, the price is going to rise. So that's what moves the market. Don't say, oh, my broker is eating up my profits. The broker is moving the market. The broker doesn't move the market. In fact, the broker wants you to make money. Why do the broker want you to make money? Because the broker makes profits from your commissions. The broker doesn't want you to lose money. You have to know this. So you have to be very, very careful. If you lose, your money is not going to the broker. If you place a sell order and I place the buy order, if the market goes up, you might lose your money to me because you don't know where to buy, when to sell. So make sure you watch this video until the end. And now I'm going to show you where exactly to click the buy, where exactly to click the sell. Before we do that, let's do a little recap of what we have done so far. Now, we talked about a simple framework that tells you where to buy, what to do, when to buy, and how do you exit the market. So market structure, area of value, entry trigger, and exits is the 4 things that you need if you want to make money with technical analysis. So market structure is the trend or the direction of the market. It tells you what to be looking for. Are you looking to buy at this time? Are you looking to sell? Or are you looking to get away from the market? Number 2, the area of value is what tells you the place, the area where the market is going to reverse on, the area where there is likely probability that if you place the trade, you are going to make profits. And then support and resistance can be used to find the area of value. Now let's move on to the entry trigger. Now you know how to determine the direction, and you know what to do. If you're in an uptrend, you're looking to buy. If you're in a downtrend, you're looking to sell. If you're in a choppy or range market, you are looking to buy low and sell high. And then now you know the area of value is the support. Don't buy when the market doesn't reach a support level. I'm gonna show you all these 3 things in play, right? Now let's talk about the entry trigger, right? So what is it exactly that you need to see before clicking that buy button or clicking that sell button? Number 1, you need the entry trigger. The entry trigger tells you when exactly to enter, right? And it helps you avoid entering the market too soon or too late, right? So there's scenarios in the market where you just open, you see a setup, and you are like too late. There's a 3, 4, 5 candles in your direction, and now you just say, I can't lose this, I can't miss this trade, and just place this trade, and boom, you lose money, and you say the broker is eating up my profits and something like that, right? But the truth is you are entering the trade at the wrong time, right? So you can use candlestick patterns or chart patterns to identify the entry trigger, the reasons for entering the trade, right? And let me show you what is a candlestick pattern and how you can use it, right? Make sure you pay attention here, because this topic, there's a lot of drawings that is going to happen here. This topic is where I do a lot of screen annotations to show you exactly what is happening. So the candlestick pattern is what can show you the shift in momentum, or if the market is really continuing going in that direction, or if the market is really about to reverse. You use a candlestick pattern, right? Because there's a lot of candlestick patterns. The candles can come in different shapes, different forms, different sizes, but there are 2 types of candles that I want to teach you in this video, in this training. 2 types of candles that I want you to look at, right? Look at those 2 types of candles, and then make sure you really know them. Number 1 is called the hammer or shooting star, and this is the type of candle that I'm talking about. So for this type of candle here, you need to understand that this type of candle here is you need to understand that this type of candle here is a momentum shifting candle. So what do I mean? That if you see this type of candle is a bullish engulfing candle. So it opens somewhere right here, and it moves down to the downside, and it creates a low here, and from there, this candle, from this point here, the candle closed above, which means from this point here the market moved to the above point, right? So as you can see from these arrows, the price started here, moved down, and then buyers took control, because when the market is moving down, the sellers are in control, and now the buyers say, okay, we are going to get this, and they are going to take this market, right there. Now you can see that from this point here, moving from this point here up to this point here, it simply means there were now more buyers than sellers in this market, right? So as I said, if there's more buyers than sellers, the market is going to reverse. So moving like this, a long wick like this, right? Some call it a shadow, but if you see a long wick like this, it shows that there's rejection to that side, right? If you ever see a candle, even if it looks something like this, it simply means there was a lot of rejection here and there was a lot of rejection here. And if the body of the candle is on the middle, it simply shows that the market closed with indecisions, right? Now, if you look at this candle, as I said, if it opened right here, moved back down, and shifted momentum to close above the opening price, it simply means now buyers can take control. So if the market was moving in a downtrend, the market is likely to reverse now. I'm going to show you another example, and I'm going to show you real chart examples of these candlesticks really working in action, and you can understand exactly why am I saying you should use these candles as entry triggers. And I'm going to show you how to connect this with market structure, area of value, and your exits, right? Number 2 type of candle that I'm going to show you is called the bullish engulfing candle or the bearish engulfing candle. This comes in 2 ways. It can come to an upside showing a reversal, and it can come to a downside showing another reversal. So if, for example, if you see the market moving down like this, right, and then you see now that there is, from here, the market opened here, it moved down and it closed here, right? So this was the open. Poor drawing. So the market opened here and then it closed right here, right? And the market was moving down. The sellers were in control. And then on the next 5 minutes, so let's say we're trading on a 5-minute time frame. This was the first 5 minutes. On the next 5 minutes, what happened is the market opened right here, right? And closed above. Now it shows that in the next 5 minutes, there is now more buyers than sellers, and the market is likely to shift momentum. Now, if you can see this, you can see that here we have a chart which is, let's put our framework in play right here. We see a chart. What is the market? What is the market structure of this chart? What is the direction of the market? It's in a downtrend, right? Why? Because we are seeing a series of lower lows and higher lows, lower lows and higher lows, right? We are in a downtrend. Now, what is the next thing that we are going to look at? Area of value. Because we now know that in this chart, we are always looking to sell so that we can increase our chances of winning. Guys, trading is always doing with increasing your chances of winning. You are never going to win 100% of the time, but you are going to win some and lose some. But you want to increase your chances of winning as much as you can. So how you can do that is using this simple framework that I'm showing. Now we know that we are in a downtrend, right? And our area of value is this support level here. If you see this red line here, this is our area of value. This is a downtrend line, right? So you can see that every time when the market was hitting this downtrend, it was pushed down, right? And now what do you see right here? Look at this, guys. What do you see right here? This is simply a bearish engulfing candle, right? What do we see here? We see that the market have turned the momentum. So the market opened here on the first candle and closed here. I hope you are seeing this. And then what happens in the next candle is the market opened right here and closed right below here, right? This simply means the market have shifted momentum and the market is now going into the downside. All right, now we are looking to sell. Now this was our entry trigger, right? We know that it's a downtrend. We have in our area of value, and we see our entry trigger right here. And now we are looking to sell. Where do we sell? After the close of the entry trigger, after the formation of these two candles should be formed and closed, right? The way that you avoid entering the trade too late or too early is you don't want to place a trade before the market closing, before the last candlestick close, right? So if your entry trigger consists of 2 candles, right, you want to wait until the close of this candle before you click your sell. Now you have confirmed that this is an entry trigger, right? Let me show you one more example, right? So this is not like the whole framework in place, but I want to show you that the hammer can also show you market reversal. As you can see here, the market was moving in a downtrend, in a downside, and what do you see here? You see a small candle with a lot or a huge reversal, right? A huge price rejection. I mean price rejection here, and it can show that the next candle that is coming right here is green, and it looks like the buyers have already taken momentum. So what you can do here is you are looking to sell at this level here, right? To buy, I mean to buy at this level here. But if you want, if this is not an area of value, so okay, if this is not an area of value, right? So if this was not an area of value before, right? What you are looking here, so let's say you had placed your trade right here. Let's say you had placed your trade, your sell order here, your sell order here. What you can do is, once you see this candle with a lot of rejection, you can exit the market, take your profits, and close the market, right? Now let's talk about the exits, right? This is the last part of the framework. The exit is what tells you when to exit. How do you exit the market, right? So the two ways that you can do is, number one, using area of value. Number two is sticking to your risk to reward ratio, right? So maybe you have a trading plan that says you cannot afford to lose more than 20 pips. So maybe that's when you use risk to reward. But the best way of doing this is using area of value. So let me show you an example of how this works. So let's say you were in a downtrend and you had placed your sell order right here. So if you place a sell order right here, right, but you need to place this sell order after seeing an entry trigger and confirming that this is a downtrend, and you see an area of value, which is this recent market reversal point here. So now if you sell right here, you want to put your stop loss above this level here. This is where most traders do wrong things. Most people will just place a stop loss above, right? They don't even care about where the stop loss is. They don't even calculate how many pips, how much money are they going to lose if they lose that trade, right? So you don't want to be doing that. What you want to do is you want to place the stop loss above the recent level of structure. Why is this important? Because the next time, if the market doesn't move down and if the market starts moving up, right, there is more likely chances that you can be saved by this zone here, and then the market will will respect this previous level of support. I hope this is understandable, guys. Let's move on to the example and let me show you how to put your exits, right? So let's say you were placing so this was a downtrend. So for example, let's say you were placing your sell order right here, right? So let's say you sell right here. So what you want to do is you want to put your stop loss above the previous levels. Here you can look at this level here when the market reacted, right? You want to place your stop loss. Don't just place your stop loss anyway. Place your stop loss below or above a previous level of support or resistance, so that if your trade doesn't go straight away into your direction, you can be saved by the previous level of support and resistance, right? So let me show you another example of the exits in play, right? Now for this example, I will show you what I mean by following the framework. So number one thing we are looking for the direction of the market. The market is in a downtrend. I'm only looking to sell. And now the next thing is I'm looking for areas of value. So if you look at these green lines here, I marked this level because I wanted to use this for this example, right? But you can see that the market comes and reverses from this level. It comes back up and it breaks past the level. And as I said before, if the prices breaks past the support level, that support level is likely to turn into resistance, right? So for example, if you sell here on this level, you want to put your exit above this previous level. So you put your stop loss above this. Why? Because if the market doesn't respect this level and continues going up, it's likely to respect this level and go down, so that you can still make your profits. So make sure you master this. Now let's do a little recap, and I will give you some examples where I show you all these 4 things of our framework. These are the only 4 things that you need to master technical analysis, right? Now let's do a recap. Number 1, technical analysis is the study of past price data to predict future price movement. And then you should not try to know everything about technical analysis. Instead, you need to focus on this simple framework, right? And the framework consists of the market structure, which is direction of the market. It tells you what to do. When you look at the charts, you know what are you be trying to do. So you can say, okay, it's an uptrend, I'm only be looking to buy here. The only trades that I'm gonna trade here are buy trades. And then area of value also tells you where exactly are the zones where I'm looking to buy. And then entry trigger shows you when exactly to place the trade. And then for the exits, you want to know how are you going to exit. If you enter a trade, you need to know how are you going to exit. So market structure tells you what to do. Area of value tells you where to buy or sell. Entry trigger tells you when to buy or sell. And then your exit tells you how to exit the market. So let's combine this framework, and let me show you some examples where you can put these things in play and make money trading with this simple framework. Number 1, if you look at this chart here, you can tell that there is an area of value here. First, you need to know that this chart was in a sideways trend right here. And look what happened. Look what happened here. Right. So let me do this. Look what happened right here. Right. If I zoom this out, right, you can see that we were in an area of value, right? Firstly, we managed to understand the market structure. This is a sideways trend, right? This is a choppy market, a ranging market. It's going in a sideways, right? And now on the resistance zone, we are looking to sell because it's in sideways. So we sell at resistance and we buy at support. Sell at resistance and buy at support. Now at the sell level, at the resistance level, what do you see here? You see a bearish engulfing candle. What do we call this a bearish engulfing candle? It opened right here. It closed above. And then in the next hour, it opened right here and closed below. So it moved up and moved down. So this is shift in momentum. And then where there you are looking to sell, right? You're looking to sell. And then for the stop loss, you want to put it above this previous candle here. So you stop loss. And then you take profits, you put it down below. And if you follow this framework, I can assure you that you can find more winning trades than losing trades. You are never going to get 100% win rate. I will never tell you that you are going to win 100% of the time. In trading, you're going to lose some, win some, but make sure your wins are bigger than your losses. So you have to make sure that your mind game is strong and you can stay in the trade and ride the trade as much as you can, right? It's really, really hard for someone it's really hard for someone to really ride the trend than riding the loss, because if you are in a loss side, you are just adjusting and say, okay, let me wait a little bit, I cannot lose $100, let me wait a little bit. And now you see it's 150, 200 minus 250, and I say, okay, I'm fed up, I'm just losing, right? But what's the difference of losing 250, just like instead of just losing $100? If you just made a decision that, okay, my exit rule is if the market passes this level, I'm off. So you lose that $100. It's better than someone who keeps dragging the stop loss down, right? The only thing that you can do is drag the take profits, because you are looking for the more chances of winning, right? So here is simply the framework in play. Here's another example, right? If you look at this, so I'm going to show you this like this. If you look at this, you can see that the market was moving in a downtrend, right? In a downtrend, in a downtrend, in a downtrend, in a downtrend, right? And now we see that the market structure is a downtrend. We are only looking to sell, right? Now we are looking for area of value. Where exactly should we sell? We are looking at levels of support and resistance, right? Levels of support and resistance. Now what do we see at this level of resistance? We see an entry trigger, right? So which one is the entry trigger? It's right here, bearish engulfing candle. So after this training, guys, I don't want you to forget about the bearish and the bullish engulfing candle, because I've showed it many times, right? Look at this. So this is, you be selling here, and for your take profits, you want to make sure that you place it above this level. Stop loss, I mean, this is the stop loss, and your take profit is below, right? Now let me show you another example. So in this example, we are going to use the trend line as our area of value. But first, before we go to area of value, we are looking for market structure. What is the market structure? It's an uptrend, right? The market is going up, right? And what is happening? The market is moving up and bouncing off this line, and this line is acting as a trend line, which is our support level, because the support level can come as a horizontal line and it can come as a diagonal line, which is called a trend line, right? Now if you look at this here, on this area of value, what do you see? I'm seeing a bullish engulfing candle, right? I hope you can see this. I hope you can see this, right? We see the market opening here, closing below, and then what happens next? You see the market opening here, closing above, right? So for the first time we see the market going down, and now we see the market is now going up, showing shift in momentum, right? So what do we do when we do that? We buy, right? We see after the close of this candle, this was our entry trigger, we buy, and you put our stop loss below this level. Make sure it's below this level. You don't want to buy here and you put your stop loss here. No. You want to put your stop loss below this level, because you want to know, okay, if the market cannot respect this level, right? So what I could recommend you to do is put your stop loss below this level here, so that if the market doesn't respect here, it can even come to this point here and bounce off this level, because there's going to be more traders who are looking to buy at this level, since it was a level of structure. So you want to put your buy order here, you want to put your stop loss here. So don't worry if there's more space between the stop loss and the entry point. All you want to do, if you are using a huge stop loss, you want to use small lot size, right? Reduce your size of it, the size of the trade. There's no need to be greedy. You are in this game to make profits constantly. You are not in this game to rip off the market in one day. If you try to do that, you are going to lose more money than you ever win. The next example that I'm going to show you, the next example that I'm gonna show you is this beautiful chart here. So in this chart, you can see that what is the market structure? The market structure here is the downtrend, right? So what do we do in a downtrend? We sell. We're always looking to sell, but no, we are not selling anyway. We are looking for area of value. Now for the area of value, what is the area of value? We are looking for areas of support and resistance, right? So for area of support and resistance, you are looking for areas where the market reversed on, right? These are all areas of value, right? And if you extend these lines up to this point here, you can see that if the market continues going up, it's always going to make a little bit of reaction to each and every zone that you draw, right? Now if you look at this, our area of values is this. but we are looking for an entry trigger. So let's say we were buying, we were moving down, up, down, and this was our area of value, right? And on this area of value, now we are looking for selling opportunity. Now, since we want to sell in a downtrend and we want to sell it in area of value, we always wait for the market to break below and create a pullback into that area, right? And on that area, we are looking to see an entry trigger. The entry trigger can be the bearish engulfing candle, because we are going down. We are looking for a bearish engulfing candle, right? So right now, as you can see here, there is a bearish engulfing candle, right? If you look at this, the market opened right here, closed above, and then next time it opened and closed. So it's going down, and here it was going up. And as you can see, there's shift in momentum. You sell and you put your stop loss. So guys, if I'm talking something that is making really sense, that's making a lot of sense to you right now, smash that like button again, right? If you did, don't smash, because it will delete the like that you placed it the first time, right? Now let's move on to the question and answers. I'm gonna answer one question or two of the questions that I often receive in technical analysis trading. Now, the first question is gonna be, how do you draw levels of support and resistance? Now, I cannot teach you the whole video of drawing support and resistance, but what I can teach you is, if you are drawing support and resistance, you don't have to treat it as lines, treat it as zones. Because what happens if the market is in a range, it will not move into exact points like this, right? We can use this in our teachings so that you can understand, but when you enter into the market exactly, you are going to see market can do something like this. And now you end up not knowing which exactly is the level that I need to be looking at, right? So the thing is, if you are drawing support and resistance in this kind of situations, what you want to do is just draw a rectangle that covers a lot of space, right? And why am I saying this? Because when the market is reversing, it's not going to reverse because of your trade, right? You have to know that there's a lot of people involved in this. If the buyers are going to take momentum, it's not going to it's not going to happen with one click of a button, one click of your trade. It's going to happen with a lot of buyers getting in, and buyers get into the trade at different times, because emotion is going to come into each and every trader. And some of the traders will delay to place their order. Some will be delayed by their trading platform. Maybe their broker's platform is slow. Some of them, maybe they're just hesitating. Some of them, they are placing little like some traders do. If a trader want to place like a huge trade, most people, they don't want to place that one huge trade. They'll just buy in pieces. So the market will not just reverse just like this. The market will take its time to reverse. The market will always take time to reverse. That's why you see the market doesn't move in a straight line. It moves in waves or ranges, right? This is because if it's not you who are turning the market, there's a lot of people that needs to be involved in that training. Now, thank you for watching this training up to the end. If you did watch up to this end, please message me below in the comment section just to say I watched the end, and I'm gonna see what surprise can I do to you, because you really dedicated your time here as I did. It's almost maybe an hour right now, and I'm gonna see you in the next video when I come with more trainings like this. Thank you.